Good morning, students. Good morning, Miss Morris. Welcome to this class today. We are going to, first of all, continue with our discussion of the notes that we've provided on property, plant, and equipment. So that is what you should be able to see in front of you now. Thereafter, I'm going to display a slightly different document where we are going to continue our discussion on. It is not available to you yet, but I will make it available after the class. Right, ladies and gents, so let us just continue on the page, basically where we left off last time. So we're on the page that has the heading, the cost model and revaluation model. So generally speaking, when it comes to non-current assets and property, plant and equipment in particular, we can distinguish between two models. The first model is called the cost model. And as you can see in the next paragraph, in Financial Accounting 1, we will only be focusing on the cost model. And then also the revaluation model. We spoke about this last week, where it is quite appropriate for fixed property, which in fact increases in value over time, to rather use the revaluation model. So the revaluation model in Financial Accounting 2, we are going to talk a little bit about that, applied to a certain extent, but mostly in General Financial Reporting 4. In the Advanced Diploma, we are going to look at the revaluation model in its entirety. So we are going to be focusing on the cost model, ladies and gentlemen, and a little bit later, we are going to see exactly how we determine the cost. We've actually spoken about that last week already, but later on today, when we deal with this document as well as the other document, we are just going to cover it more thoroughly. Right, ladies and gentlemen, you've all now heard about cost, you've all heard about depreciation, you've heard about accumulated depreciation. So this is where we are going to start talking about all of those terms, including residual values, expected useful life, all of those kind of things. Right, so there are quite a number of terms that we will have to discuss during the course of today's session, as well as next week and probably the week thereafter. So, ladies and gentlemen, we all now know that initially when we acquire an item of property, plant and equipment, we are going to record it or recognize it at its cost. And how we determine the cost, even though we've mentioned that last week, we're going to talk about that again. But then subsequently, ladies and gentlemen, later on, after we've been using the property, plant and equipment items for a certain period of time, we will have to go and draw up financial statements, especially obviously when it comes to a year end, or in the case of listed companies at the interim period after the first 6 months of their financial year. Then we've got to go and take a few other things into account amongst, well, the most important when it comes to property, plant and equipment is how much of that cost have we actually consumed by using that asset during the course of the year. And that is represented by what we refer to as the accumulated depreciation. So every time or each year that we use that specific asset, except if it is fixed property, like we said, it will lose some of its value because we are actually using it, right? Therefore, we are going to write off depreciation each year on all our various property, plant and equipment categories, and we are going to accumulate each year's depreciation expense in an accumulated depreciation account. So for our purposes, we can now see when it comes to the value. In auditing, they speak about the valuation, but let's just say the value of each asset, we will have to have two separate accounts. In Financial Accounting 2, we'll see there might be a third account that deals with accumulated impairment losses, but we will ignore that for the time being. We'll only address that next year when we get to Financial Accounting 2. So first of all, we'll need an account that contains the cost of that particular asset or that particular asset category. Now, if I say a particular asset, you may find in certain instances that an asset, a property, plant, and equipment item is so important, so huge in value and importance in general that it has its own cost account. For instance, if you have a fleet of, let's say, 5 or 6 aircraft, passenger aircraft, you will and all of them cost like hundreds of millions of dollars each, then you are probably going to have a cost account for each one of them separately. Let's say Airbus A320 called Drakensberg or whatever, right? And Airbus 340 called Amazulu or whatever the case may be, right? But anyway, the fact is that is when it is a very, very important or very expensive kind of property, plant, and equipment item. For smaller items, we'd rather group them together within a category such as vehicles, or plant and equipment, or office furniture. So we'll then have a cost account for that whole category or group of property, plant, and equipment items that are of a similar nature. So, ladies and gentlemen, the two accounts that we need, either for the particular asset or for that category of assets, is the account that contains its cost. And secondly, we will need an account which contains its accumulated depreciation. Now, clearly the cost account will be an asset account, and we reduce that cost eventually when we subsequently value that item or that category of items by deducting the accumulated depreciation. So therefore, that is very often referred to as a negative asset account. Now, ladies and gentlemen, there's something that I want to emphasize here. It's unfortunately not in your textbook. The ninth edition, which we think will be available as from next year, I think. Hopefully, they will implement that. I am certainly advocating its implementation. You'll see that your textbooks very often only refers to the account as cost, or it only refers to the account as accumulated depreciation. But what we must realize, and I want us to go that step further, is that for each category or even individual property, plant, and equipment, we'll have a cost account, right? So for your vehicles, you could have a cost account. For your plant and machinery, you could have a cost account. For your Airbus 340, you might have a separate cost account. For your office furniture and office equipment, you might have a separate cost account. So therefore, right from the start, I want us to set this convention that when we name our ledger accounts, and in my other document, I'm going to just indicate that as well. We are going to start with the name of the category of items, such as vehicles or property or office furniture. And then we have a colon when we do our books manually, and then we indicate what the account contains. Does it contain the cost, or does it contain the accumulated depreciation? Here we've got the example in the notes of a typical name for an account: vehicle colon cost and vehicle colon accumulated depreciation. Now, Ms. Morris also presents accounting information systems, where she, amongst other things, presents Sage 1 Cloud Accounting. So, ladies and gentlemen, there's another reason why we want to set this convention. The likelihood that you will be doing your financial accounting one day when you are out there practicing your trade, that you will do it in a manual system, is very, very small. It's very remote. The chances are very close to 100% that when you are going to be practicing as an accountant, you are going to do it on a computer package, right? And most of them work very similar, whether it's Sage 1 or QuickBooks or whatever. Ms. Morris knows all about that. Uh, what you will normally do, you will create a specific kind of account, such as vehicles, and then you will create sub-accounts for it. Even if we go maybe one step higher, you will have a whole set of accounts that deal with your property, plant, and equipment, right? And then under your property, plant, and equipment accounts, you will have the various categories, cost accounts, many of them. There could be hundreds of them. And all those categories accumulated depreciation accounts. So this also helps us prepare for that. So we already think into the future that we might have to apply these principles that we are discussing now, not only in a manual system, but also in a computerized system. We don't need to discuss all of what is in the notes, just a few items that I want to point out. The useful life, ladies and gentlemen, we discussed that last time. Then just a few things that we need to discuss here, which is quite important. When does the depreciation process begin? When does the depreciation process begin? Now, I'm going to ask you three questions. The answer is right in front of you, in fact. Thank you, Ms. Morris, for that comment. Yes, the answer is right in front of you. When you acquire any item of property, plant, and equipment, and you are going to start using it, potentially, there are three possible dates in which you can start the depreciation process. The possible dates are the date of acquisition, when you actually purchase the item. Another possible date, ladies and gentlemen, is when you start using that asset. And a third possible date is when that asset is ready and available for use. Now, perhaps before you type an answer for me in the chat there, before you type an answer, I just want to tell you what they mean when an item is ready and available for use. You'll see later on today when we hopefully start with our first class question. It might not be today, it might be next week. We'll see how the time allows us. But we are going to do a few questions in class. Then you'll see that very often when you are constructing an asset, such as plant and machinery, plant and machinery, whatever, it might take a while. You might purchase the various components of the plant and machinery at various times. You might have to install it. You might have to get engineers to assist you in installing it. There might be all sorts of processes. So, ladies and gentlemen, what they actually mean by when an item is available for use is the date when you stop capitalizing any further costs and you can actually start using the asset as you as a business intends to use it. So, ladies and gentlemen, out of those three possible dates, the date of acquisition, the date when you actually start using the asset, or the date when the asset is ready for use, which one of those three dates should you start the depreciation process? If you can type a little answer for me there, please. It is actually right in front of you, but I still want to see whether we are all on the same page here. When do you start the depreciation process out of those three possible dates? When the asset is available for use. Thank you, Inati. When it is available for use or ready for use. IAS 16 actually uses both of those terms, when it's ready for use or available for use. So that is why we've got that little example there. Let me just go back to Word. Little example there that, let's say, for instance, you've purchased a plant or any other kind of property, plant, and equipment on the 1st of January. It is ready for use on the 1st of February, but you actually only start using it on the 1st of March. Then you will start your depreciation process on the 1st of February when it was ready for use. So that is just an important thing that we must keep in mind. Here I've left a few notes in. Like I said, this I wrote for multiple levels of financial accounting. But obviously, most of the items that relate to financial accounting 2 or 3 I've left out, but I've also left a few in. So where I'm indicating FA3 or FA2, it means it's just something to take note of, but it is not something that is applicable to financial accounting 1 yet. Just perhaps the third one, the third bullet there is quite interesting for us, where they say if an asset is for a time being, for a little while, not being used, in other words, it's lying idle, if you are using any of the time-based depreciation methods, in other words, your straight line method or your diminishing balance method, then you should not stop the depreciation process. It should actually continue. As we'll see later, when it comes to the unit of production or usage method, the opposite applies automatically because of its very nature. The depreciation process will pause when the item is idle for a little while. Then when does the depreciation process end, ladies and gentlemen? The depreciation process ends at the earlier date when that asset is either being transferred to an asset held for sale account in accordance with IFRS 5. Now, you don't need to worry too much about that at this stage. That is, again, something we are going to address in general financial reporting 4. But that is just when what happens there is if the business, if its nature of business changes, and suddenly those items that used to be property, plant, and equipment are now going to be sold off because the business is not going to use them for its previous purpose anymore. And then the other possible date is when the asset is derecognized. Now, perhaps you can just make a little note there, ladies and gentlemen. I'm sorry I didn't type it in the notes here. I think I might have it in one of my other documents. When is an asset derecognized? There are basically two sets of circumstances when an asset is derecognized. What does derecognized mean? Derecognized means you are taking out any balance that relates to that asset. In other words, its cost and its accumulated depreciation. You take it out of your books of account so that there is no further balance relating to that asset anymore. So maybe you can just start for me again there. Can you think of any such circumstances? Like I say, there are two, but if you can type at least one for me, I'll be very, very pleased. When do you think will be appropriate to derecognize an asset to get rid of any balance that relates to it? When what happens? That is one possibility. Thank you, Sibusiso. When the accumulated depreciation exhausts the cost. In other words, when it is fully depreciated, that is actually the second scenario. So what they are saying in IAS 1 is if that asset has got no further potential economic benefits for you, if it has become worthless to you, you cannot sell it. Right? Nobody wants it because it's redundant or it's broken or whatever, then it should be derecognized. Right? So if it has no further future economic benefits, in other words, you cannot use it anymore and you cannot sell it either. So that is the one possibility. The other possibility is obviously when you do what with that? When you actually dispose of it, right? So then you really do no longer own it. So when you dispose of it, you can possibly get some proceeds on the disposal of that item. So you can sell it, ladies and gentlemen, but it no longer then belongs to you. So then you have to derecognize it, right? So the two situations, either when you dispose of it or if that asset has become worthless. Right, then we just mentioned there a few factors that may influence the expected useful life. Remember, we said last week it might not be the full potential lifetime of that asset. You might want to sell it before it becomes useless, right? So that you actually can sell it to another user who can use it further for a few years. But the expected useful lifetime is the number of years or months that you as a business intends to use that asset. Right, so there are just a few factors that will be taken into account. How much wear and tear will there be? In other words, what how much will it lose its value in a particular year? So just a few things to be taken into account there. Now we are going to start looking at purchase price and cost, but also how we actually go and record or recognize items. Now, ladies and gentlemen, we'll see a little bit later. We've spoken about that already last week, but we are going to talk about it again this week. We saw that the cost of property, plant, and equipment would normally contain three, or could potentially contain three factors, right? The first factor is its purchase price, its purchase price. The second factor, which we also mentioned last week, is something called directly attributable cost, which we are going to discuss in detail a little bit later today. The third possible factor is any certain future cost, which we said we are not going to deal with in financial accounting one yet. We must just know about that. So let us start with the purchase price, ladies and gentlemen. The purchase price is defined as the cash price equivalent on the date of recognition. So really, if you want to, I suggest you make a note here, ladies and gentlemen. Once again, you make your own little notes on the side here. So the purchase price, in effect, is what you are going to pay for that item, right? It doesn't necessarily mean you're going to pay cash for it today when you acquire it. You might acquire it on credit and pay the cash maybe in a month or 2 months' time. But what the cash price will be when you actually pay it, either today or in a month's time, right? So that is what is meant by the purchase price, what you pay for it. Now, ladies and gentlemen, I want us to go and record a few journal entries here. So we are going to go through a few basic examples, and then we are going to make it slightly more complicated as we go along. So in this example, we say on the 1st of January 2020, Mats Limited purchased machine A, and let's say they are going to have a separate accounts for that machine for 100,000 Rand. So that is the purchase price. Then they continue and they say payment will take place 3 months later on the 30th of March 2020. And the payment within 3 months is considered to be within normal credit terms. When it's outside of normal credit terms, which is normally when they can pay more than a year later, then we factor in what finance cost as well, but that we only do in financial accounting too. So now we are required to do the journal entry to record the purchase. So now I'm going to ask you a few questions again. If you can type for me, please, ladies and gents. Which account do you think should be debited in this case? If you can type for me a full name of an account, considering what we've spoken about a few minutes ago about account names. Thank you for that one. But remember, now we're getting closer. We're getting closer. Thank you, Sibusiso. In this particular case, it's not actually equipment. It is actually A machine. So if you are going to combine it with other machines, you will probably call that category machinery. Machinery. If you are going to create a separate account for this particular machine, you're going to call it machine A. And then colon, and like Sibusiso mentioned there, as well as Kelsey, what does the account contain? You must include that in the name of your account. Otherwise, later on down the line, you're going to become confused. What account is this? Is this the one that deals with machinery, or is this the one that deals with equipment? Does it contain the cost, or does it contain the accumulated depreciation? So we've got to be clear on that right from the word go, right from the start, right? So let us look at our journal entry. By the way, if you are going to pay cash for it, obviously you are going to credit your bank account, but in this case, we see that we are only going to pay for that within the next 3 months. So therefore, we are going to credit our creditors or our accounts payable. So here we illustrate that, ladies and gentlemen. So we're debiting machine A in the case where we are going to have an individual account for that, colon, cost, right? If we are going to combine this machine with many other machines, then we're going to do it by means of its category. Then we're not going to call it machine A, we are going to call it machinery. Machinery, colon, cost, right? Now, ladies and gentlemen, let us talk about the initial cost. We've basically already started the discussion, so let us just continue with that in a more formal fashion now. Right, so the purchase price, ladies and gentlemen, we've said is basically what you pay for it. So what you pay for it will be after you have deducted any discounts or rebates, right? So after taking that into account. As we've seen last week, we've spoken about this. If your business is a registered VAT vendor, then the value added tax is not a cost to your business because you can claim it back from the revenue service. So therefore, it is not included in the purchase price. However, if your business is not a registered VAT vendor, it is a cost. Then value added tax is a cost to your business. Then you will include it in the purchase price. Then the matter of directly attributable cost, which we started discussing last week, we're going to continue with that, and also certain future costs, such as the cost of dismantling an asset at the end of its useful life, should also be capitalized if it is known upfront, right? But that we are going to discuss in financial accounting too. So now let us just again talk about directly attributable cost. Later on, when we are going to do our first class example or our first class exercise, we are going to come back to the matter of directly attributable cost. Let me just go to collaborate. Yes, Ms. Morris.
Sorry, sir. Sibasis is actually asking a good question in the chat. He says, sir, in a manufacturing business, do we have separate equipment and machinery accounts?
Yes. Thank you, Ms. Morris. Thank you, Sibusiso, for the question. It all depends on the function, the nature and the function, ladies and gentlemen. In financial accounting too, we are going to take this whole argument, and I'm actually very glad we're starting it now already, so that you can think about it. But then we are going to discuss it in depth. IAS 16 basically defines that your category, you are going to look at its nature and its function, in order to create categories of property, plant, and equipment. So to answer your question, let me just read that thoroughly before I answer. In the manufacturing business, do we have separate equipment and machinery accounts? Okay. So it's all going to depend on the excuse me, the nature or the function of that kind of property, plant, and equipment. So if you, and remember, we as accountants, we've got to make a lot of decisions. We are training to become accountants so that we can have what we refer to as professional judgment, so that we can make major and important decisions, right? We are decision makers eventually when we are accountants, right? So if the nature of your or the function of your equipment and your machinery is different, then you should have separate accounts for them. So let us maybe have a look at a few examples. If you are in a manufacturing company, Sibusiso and everyone else, and your machinery, the function of your machinery is purely to produce a product. It is purely to produce a product. It's actually very fascinating to visit some of these manufacturing concerns. One of the most interesting I've ever visited was the bottling plant of SA Bottling Company. The SA Bottling Company does the bottling on behalf of Coca-Cola, the Coca-Cola company. In other words, Coca-Cola and Fanta and Sparletta, those cool drinks. So it excludes the Pepsi companies. But the manufacturing process is quite amazing, because it starts where it starts and where it ends is about half a kilometer from one another. It's a huge, long factory line. So it basically starts where old bottles are being washed, right? They are being washed and sanitized, and then there's all sorts of things. Then it gets onto a conveyor belt, right? Thousands of bottles at a time. Gets on a conveyor belt, and then at some point it gets on a turntable, and there are about, I think, about 12 bottles on the turntable at any point in time before it carries on with the rest of the conveyor belt. And then it squirts in basically, it's not even the whole cool drink. It is just the flavors. It's almost like a paste that it squirts in, right? And then it carries on to its next stage. And then it gets on another turntable, and then it squirts in water. And then it carries on with the conveyor belt to the next stage, and then it gets on another turntable, and then they squeeze in the gas, the carbon dioxide gas that makes it fizzy. Then they spurt that into the bottle and into the cool drink, and then it goes on again on the conveyor belt to its next destination. The next destination where it gets capped. It gets capped. The cap is put on the bottle. I'm only talking bottles at this stage. I'm not sure exactly how they do the tins. I didn't see that actually, now that I come to think of it. And then it carries on, ladies and gentlemen, and then it gets automatically packed into boxes. So it's a huge conveyor belt. But anyway, I'm digressing. So what I'm saying is those machinery that are specifically part of that whole conveyor system, that is directly involved in the manufacturing of the product, that if that has a different function to your other equipment, which I'll give you an example of now, then you will capitalize it under a separate account, which you then call your machinery or your plant and machinery. Does that make sense? Hopefully. So that will be your plant and machinery. Then you might have other equipment, ladies and gentlemen, that labels the boxes for you, right? So all they do, they put on a label saying this is a 1 liter or a 2 liter case of bottles, and this is the weighting, and this is that. If it labels, but it doesn't actually it's not part of the manufacturing process, then you would not include those items under your machinery or your plant and machinery. You will include that in a separate account that contains the cost of equipment. Right, I hope that makes sense. Subhasisa, does that answer your question? It all depends. Does it have the same function? Does it have the same nature, or does it have a different function, or is it of a different nature? Okay, perfect. Then I'm very, very, very glad about that. Okay, so ladies and gentlemen, now let's talk about directly attributable costs. We're going to talk quite a bit about that today. And also when we do our first class question, we are going to use this principle and applied in that class question. So what is meant by directly attributable cost? I've bolded certain words there. It's not bolded in IAS 16, but those are the three important things that we need to make a decision on later on when we decide whether an item or a cost that we've incurred is a directly attributable cost or not. And the reason, ladies and gentlemen, if we can just maybe talk about that up front, if it is regarded as directly attributable cost, as you can see just above there, it will form part of the cost. So you are going to capitalize that cost as part of the cost of the asset. If it is not seen as a directly attributable cost, in that case, you are not going to capitalize it as part of the cost of the asset, but rather you are going to write it off as an expense, right? So that is quite a major decision because sometimes these expenses or costs can be quite substantial or material, as we say, right? So what is a directly attributable cost, ladies and gentlemen? It is a cost that was necessarily incurred. In other words, our first criterion here is that it must be a necessary cost. It's not a luxury, it is essential. It is a necessary or essential cost. And then it must play a major role in bringing the asset to either a location or place or condition where it can be used as management intends. In fact, ladies and gentlemen, IAS 2, which deals with inventories, has got almost an identical definition for directly attributable cost. It is slightly different, but it is almost identical. All the essential words like necessarily incurred and location and condition also appears there. So, ladies and gentlemen, you can remember from IAS 2, from when we discussed inventory, that our railage inwards was always capitalized as part of the cost of inventory. Why? Why was railage inward capitalized as part of the cost of inventory? Because it is a directly attributable cost. It is, first of all, a necessary cost. You have to bring the inventory to your premises in order to be able to sell it, because selling it is what management intends in that case. And it plays a major, a significant, a fundamental role in its location, right? That is why railage inwards was capitalized as part of the cost of inventory. It simply is a directly attributable cost. And the same principle applies here in IAS 16, where we deal with property, plant, and equipment. Exactly the same principle applies. And like I say, later on, we are going to look at a class question, and then we are going to put that into practice. Right, ladies and gentlemen, this we've basically discussed already. So we can just maybe look at an example here of when costs will be capitalized or not. So let us look at this example here where subsequent cost is not capitalized. In financial accounting 2, we are going to look at many kinds of examples where subsequent costs will be capitalized. But I can perhaps just give you a hint there. That is normally when you have to replace a part, right? When you have to replace an engine, or you have to replace some sort of a working part of that machine or that vehicle or that plant, right? So now I'm going to ask you to type for me a few answers here, ladies and gentlemen. They say here in this example, 2 months after the acquisition of vehicle A, Matt Limited repainted the vehicle in the company's colors, its logo, and its contact details. So they paint on there their telephone number and their email address and their website and website URL and all those kinds of things. And they say this was done for advertising purposes and the total cost was 4,000 rands. There was also maintenance cost of 2,000 paid on this date. So they probably at the same time had it serviced. So what would you say from an accounting perspective? What does your gut feel tell you? Should that be capitalized as part of the cost of the asset, or should that be written off as an expense? Expense. Thank you, Sibusiso. So your gut feel is already correct. Ah, there we get a lot of answers. You're all correct. Written off as an expense. You're quite correct, ladies and gentlemen. But how do we know that? How do we know that we should write it off as an expense? Let us look at that definition of a directly attributable cost. So first of all, we've got to ask ourselves, thank you for all those answers. I appreciate that. You're all spot on. You're all spot on, as I've expected. Okay. Is it a necessary cost? Is it necessary to paint it in the company's colors and its logo and its contact details and those kinds of things? The answer could be yes. The answer could be say, yes, it could be necessary, but you could also say no, it's not necessary. It depends on your perspective. I would say it is good marketing, so I would say it is probably necessary. It is probably necessary. But now we've got to ask subsequent questions. Does it change? Does it actually change the condition of the vehicle itself? Does it make the vehicle perform better? Does it make it go faster? No, it doesn't, right? So it does not change the condition of the vehicle itself. Does it change the location of the vehicle? Does the fact that you are painting it with a logo, does it make it go somewhere else? Or is it still staying in the same place? No, it doesn't, right? So therefore, ladies and gentlemen, because it doesn't change the condition of the car itself and it doesn't change the location of the car itself, then irrespective of whether you consider the cost to be necessary or not, it is still not a directly attributable cost and it should be written off as an expense. So you're all correct with those answers. Your gut feel is already good. So there, where we do a journal entry, we see that for the painting of the logo and the contact details, that is probably going to be, I think that should be the other way around actually. Now that the maintenance was 2,000. Sorry, let me just change that. 2,000 and the advertising expense 4,000. Sorry about that. Now that's already in your notes. It's already been uploaded, so you must just remember that so that it doesn't confuse you. But I will just save it on for future reference. Right. So the maintenance 2,000 rands will be written off as an expense, maintenance expense, and you will probably be regarding the fact that you've painted your logo and your contact details on a vehicle that's going to be seen by potential customers wherever it drives. You'll probably see that as advertising expense. Right. Uh, Now I'm going to look at an example where subsequent cost needs to be capitalized, and we've already mentioned that is normally when you have to replace a part, right? So here we are saying in example 2, on the 1st of January 2020, Mac Limited acquired a new engine for its plant for 120,000, right? So let's say the old engine for the plant has seized up. We are going to dispose of it, or we have to scrap it, whatever the case may be. Let me just see. There's a reminder that's just come up on my side. Just excuse me for a second, ladies and gents. Just want to see what this reminder is about. Teams meeting. I can't attend that one. Okay, so I'm just going to ignore that. Sorry about that interruption. So the old engine, or the old engine for that plant is seized up, and we've replaced it with a new engine. So now the question is, should that 120,000 should be written off as an expense, or should that be capitalized as part of the cost? Now, again, we have to go and refer to that definition of a directly attributable cost, and therefore that next sentence is actually quite important for us. They say this new engine will extend the useful life of the plant by 4 years. And the installation cost for this new machine was 4,000 rands, right? So, ladies and gentlemen, the fact that it will extend the useful lifetime, the fact that they mention that, we have to assume this is a necessary cost, because otherwise we cannot continue using it. Does it change the location of the asset? You all say capitalized. You are spot on. I am so impressed. Yes, right. So it does affect it is necessary, because otherwise we can't use it. Yes. Does it change the location of the plant? Let's maybe start there, so that we have to ask all the questions. It doesn't change the location, but it changes the condition, right? Right. That is important, ladies and gentlemen. Even though both of them will make it qualify as a directly attributable cost, in this particular example, the new engine is necessary, because otherwise we cannot use the plant, and it does change the condition of the plant. It doesn't change the location, but that doesn't matter, because it doesn't need to be both. Thank you, Inati. That is exactly the answer. It changes the condition, but not the location. But it only needs to do the one or the other. It doesn't need to be both. You will very rarely see that any cost will do both in any case, right? So it's got to be either the one or the other, but in all circumstances, it must be necessary. So in this case, it does affect the condition of the plant, as you say, so it should be capitalized as part of the cost of that item. By the way, ladies and gentlemen, let's talk about the installation cost separately. Should that be capitalized as part of the cost? The installation cost. What would you say, yes or no? I'm just interested to see what your gut feel is. Or maybe you've already applied the definition. Anna says yes. Asive says yes. Bisise, Enrique. Okay, everybody says yes. Oh, most of you. No, everybody. It looks like everybody. Why, ladies and gentlemen? We've got to ask ourselves, is it a necessary cost? Yes. Can we use that plant without installing the machine, or the new engine, I should say? We can't. It must be installed, otherwise it doesn't work. Right. Thank you, Zile. So it is a necessary cost, right? Does it change the location of the asset? There we can say no, because it's still in the same position. But does it change the condition? Thank you for all those notes. But now the next question, does it change the condition? Yes, it does. It now makes the plant work again, right? Otherwise, if we don't install it, the plant won't work. So therefore, that would also comply with the definition of a directly attributable cost, and we are going to capitalize it as such. Let me just go and scroll down now. So there we've got a journal entry, ladies and gentlemen. So the plant, we will see in financial accounting 3, sometimes we might have to distinguish between different significant parts, and then we're going to possibly have a third part of the name of the account where we will call it plant machinery cost, but that is for financial accounting 2, right? So you'll have a further sub account. But in any case, the fact is it must be capitalized as part of the cost of the plant. So in other words, you're going to debit the account, going to identify the category of property, plant, and equipment as plant, what does the account contain? It contains the cost, and you are going to include the 4,000 rands. In other words, the 120,000 rands that the engine cost you, plus the 4,000 rands that it cost you to install the engine so that the plant can work again, right? So you're going to combine the two there. Okay, ladies and gents, maybe this is a good time just to pause for any questions. Have you got any questions from your side? Inati, there's a question there. I'm going to deal with a penultimate one just now. Sir, we debit the cost because of the assets is increasing. Correct, Inati? Yes, the cost of the asset is increasing, and as you know, all assets increase on the debit side, right? So if it increases, it's on the debit side. If it decreases, it's on the credit side. I'll have to go and see Nangamso asked a question, but now I'll have to find it because I was focusing on the Word document at that stage. Let me just find it. There we go. For it to be capital, I think this is the question. It is from Nangamso. For it to be capitalized, does it have to only meet one criteria or meet all of them? Nangamso, we will see when we do the class question, but let us discuss it now. First of all, it must be a necessary cost, right? Remember that definition says that it must be a cost that is necessarily incurred. So it must, in all circumstances, first and foremost, be a necessary cost. Then, ladies and gentlemen, and Nangamsa in particular, and everyone else, then when it comes to the condition or the location, then it doesn't have to meet both criteria. It only needs to be the one or the other. In other words, it could only change the condition of that asset or change the location of the asset. So in that case, it doesn't have to be both. Does that answer the question? Hopefully I've interpreted that correctly. Hopefully. Okay. Well, otherwise, if it didn't, you must tell me, please. Okay, so looks like hopefully you are happy with that. Okay, now let's have a look at derecognition, ladies and gentlemen. We've already said earlier, when do you derecognize any property, plant, and equipment? It's either when you sell it, when you dispose of it, then you have to derecognize it, or when it has become worthless, if there are no possible future economic benefits that you can get from it. You're welcome, Nangamsa. Then I'm happy that we did answer that then. Thank you very much. So, ladies and gentlemen, when you either dispose of the asset or a particular part, as we'll see in financial accounting too, or it has become worthless, then we have to derecognize it. Now, when it comes to derecognition, it is exactly the opposite of recognition. So in the case of derecognition, we now have to get rid of all balances relating to that particular asset that we are going to dispose of. Let me just see the question there. Sibisiso, when we account for maintenance, do we have separate depreciation of the actual assets of the actual and the new engine? Yes. When it comes to maintenance, that is not part of your depreciation, right? It is not part of the depreciation. The depreciation, that is the value, well, that is the part of the cost that you are consuming by using that particular property, plant, and equipment item, right? But when it comes to maintenance, that is where you have to incur further cost just to keep that item running. You are not improving it. So it doesn't improve it, but it just needs to keep on running. A very good example of that is when you have to have your car serviced. When you have to have your car serviced. So you take it to the garage. They'll phone you, and they'll phone you 2 or 3 times during the day and say, but there's a problem with your brakes. That's going to cost you an additional 4,000 rands. And an hour later, they'll phone you. There's a problem with your cooling system. That's going to cost you an additional 7,000 rands. So by the end of the day, where they quoted you 4,000 rands for the service, it ends up you paying 12,000 rands for it. But anyway, those are things that need to be done. Otherwise, your car will not last you long, right? So when it comes to maintenance, Sibusiso and all other students, that is when you, that is true. I've just experienced that very recently. So that's why it's so fresh in my memory. So that is additional expenses that you've got to incur just to keep that motor vehicle or that machine or whatever asset it is in a condition that it can continue to be used, right? It doesn't make it faster. So it doesn't actually improve it, it just maintains it. So then you are going to write it off. Okay, ladies and gentlemen, I'm going to ask you a few questions now again. I know that you possibly have the notes in front of you, but then that's also good. When it comes to de-recognizing an asset after we've depreciated it for a time, as you can see in this example, they say vehicle D with a carrying value or carrying amount of 80,000 rands. The accumulated depreciation was 40,000 rands, was sold for 80,000 rands cash. Now, my first question to you, if you have to get rid of all balances relating to that asset because you are selling it, you are no longer going to own it, how many accounts will be involved? You can just type a figure for me there. Possibly three. I've actually mentioned the three the earlier, but for our purposes in financial accounting, two is actually only going to be two. So you are all correct. There is potentially three, but we are not dealing in financial accounting one with impairment losses yet. That is a financial accounting 2 and financial accounting 3 topic. So yes, there could be three. You are all correct with that, but for our purposes, there will be two. Now, can you name just those two? Can you name the two for me? Which two account balances do we need to get rid of? The cost. Thank you, Sibusiso. I should give you a medal there. And Angel as well. Thank you all. Thank you. The cost and the accumulated depreciations. You'll remember we said that we are going to debit the cost of that particular category of asset. We're going to debit that. So that account is always going to contain the cost until such time as you get rid of it, right? And then every year when we write off depreciation expense, we are going to accumulate it on an account that is called the accumulated depreciation for that particular kind of asset. So if this had been, this is vehicles, so it will be vehicles colon cost and vehicles colon accumulated depreciation. I think in this example, they actually had a separate account for vehicle D, so they haven't combined it with all the other vehicles. It might even be their only vehicle, who knows? But the fact remains, those are the two accounts that you need to get rid of the balances. Now, one more question, ladies and gentlemen. No, two more questions, actually, two more questions. If they tell us the carrying amount is 80,000 rands, and they also tell us that the accumulated depreciation at that point in time was 40,000. What would the cost have been? What would the cost therefore have been? Sibusiso, Kelsey, AG, Lucanio. Okay, now I've got a lot of answers there. You can't deduct them, ladies and gentlemen. You've got to work backwards, like everyone says there now. Lucille as well. Shamila asks how. Well, we said earlier. Remember, it's part of these notes. We said that your cost minus your accumulated depreciation gives you the, thank you, Ms. Morris. Thank you. Yeah, that RPL session, unfortunately, I will have to miss that. That was the reminder that popped up on my side as well. So I won't be able to attend that meeting. But if you can represent us, that will be great. Thank you. Oh, Ms. Morris already left. So where were we? So our carrying amount is the cost less the accumulated depreciation. So now we've got to work backwards. If our if our accumulated depreciation is 40,000 rands and our carrying amount is 80,000 rands, what would the cost have been? As most of you have said there, 120,000. You can go and check it. 120,000 cost less 40,000 accumulated depreciation, therefore gives you 80,000 rands. Right. That is one thing that exactly. Thank you there, AG. There we go. So cost plus cost. Yeah, there you've just changed the equation around. Right. Perfect. Thank you so much. That is exactly how it is. Right, ladies and gentlemen, that is important for us to know because obviously the cost is residing in a different account than the accumulated depreciation. We haven't got a carrying value account. We arrive at the carrying value by deducting the accumulated depreciation account balance from the cost account balance. That is how we arrive at the carrying value, but we haven't got an account called vehicles carrying value. There is no such an account. It's a combination of the cost and the accumulated depreciation. So therefore, we've got to go and get rid of those items, those balances, I should say. Then just one more little question, ladies and gentlemen. They say it was sold for 80,000 rands. Did we make a profit or a loss on this disposal or nothing? Neither a profit nor a loss. Nothing. Yes. Remember, the carrying amount at the date of disposal is 80,000 rands, right? So that is what is in our books, the combination of the cost less the accumulated depreciation. That is why they sometimes refer to as the carrying amount as its book value. I'm pretty sure many of you have heard before the term the book value or the net book value, right? So in our books of accounts, the combination of the cost and the accumulated depreciation accounts delivers us the carrying value or carrying amount, which is currently at 80,000, and it was also sold for 80,000. So in this case, we haven't made a profit and we haven't made a loss. We've actually sold it for exactly the amount that we are carrying in our books of account, which is probably quite a rarity. Normally, you will make either a bit of a loss or a profit, but obviously, this accountant is very, very good in estimating useful life and depreciating it, right? So that will typically be our journal entry, ladies and gentlemen. Before I display it, or maybe while I'm displaying it, let us maybe just discuss this. Remember, we are going to uh, dispose of this vehicle, right? We are selling it, so we are no longer going to own it. So by definition, when we de-recognize an asset, we are getting rid of all balances that relate to it. Now, to understand this journal entry, we have to ask ourselves a few questions here. As it stands before we dispose of it, right? Does the vehicle D cost account have a debit or a credit balance? As it stands before we dispose of it, does the vehicle D cost account have a debit balance or does it have a credit balance? Debit, because it's an asset. Thank you very much. Right. Debit, you're all spot on, 100% correct. It has a debit balance. So now, because you have disposed of that vehicle, when you sell it, if you have to get rid of that balance, what do you have to do with that cost account now? Debit or credit it? Now we've got to credit it. Right, now we've got to credit it to get rid of that total balance of 120,000 rands. Thank you so much, ladies and gentlemen. That is the last leg of that entry where we credit the cost. Here we are assuming that we sold it for 80,000 rands, so we received 80,000 rands in cash for it. Now, when it comes to the accumulated depreciation on vehicle D, right, as it stands before we sell it, before we dispose of it, does that accumulated depreciation account have a debit or a credit balance? Remember, this is now a negative asset account. Perfect, perfect. There you get it. Thank you so much for all those answers. As it stands, it has a credit balance. And now we want to get rid of that credit balance. So what do we have to do with that account now? Now we've got to go and debit the account. Thank you so much, ladies and gentlemen. Thank you so much. I can just maybe mention here, if we had made a profit or a loss, we will actually see that later on when we do some of our class examples and our class exercises. If this vehicle was not sold for its carrying amount, right? So if we, in other words, made either a profit or a loss, then we would have created another account, ladies and gentlemen. Like I say, we'll get to that in the very near future. Then we couldn't simply debit the bank account with 80,000, because now we would have sold it for more or less than the carrying amount. Then we would have taken that the difference between our cost account and our accumulated depreciation account, which is obviously the 80,000, we would have taken it to an asset disposal account, right? So we would have credited the cost of the item that we are disposing of. We would have debited the accumulated depreciation. In other words, the balancing figure would represent our carrying amount. We would then have taken it to an asset disposal account. And on the asset disposal account, we will then there record the proceeds, and then the difference between the proceeds and the carrying amount on the asset disposal account would then be either our profit or our loss on the disposal of the asset. Anyway, like I say, we will get to that further little step a little bit later. Just excuse me for a second. I just want to get rid of this reminder for the meeting that just started a few minutes ago. Otherwise, it's going to keep on popping up on my side. Now I've dismissed it. Okay. It was starting to become a little bit of a nuisance on my side, but it's gone now. Okay, ladies and gents, let us go scroll down. It made nothing. It just goes to the bank, not asset. Inati, the right thing to do. Let us talk about the right thing to do. This accountant just took a shortcut because this accountant already saw that no profit or loss was made, that it was actually sold at its carrying amount. But the correct thing to do, even if you make nothing, the correct thing to do is to take the balancing figure on this journal to an asset disposal account first. And then you would record the proceeds, and then you will see that that account automatically balances. There's no profit, there's no loss, so that account will then simply just close off. So the correct way of doing this is to take it to an asset disposal account first. But we all know that accountants, the more experienced you become, the more you take a few shortcuts. That is unfortunately the way it works. But the correct way definitely would be to take it to the asset disposal account first. So I should be preaching the right thing and not the shortcuts here. Okay, so the right thing is to take it to asset disposal. Then, ladies and gentlemen, when it comes to the disclosure, we're almost done with the notes. When it comes to the disclosure of property, plant, and equipment, you'll see that we are going to talk about various categories of non-current assets in financial accounting to We get property, plant, and equipment. We get financial assets. We get biological assets. We get intangible assets, all sorts of non-current assets. So property, plant, and equipment is one of the categories of non-current assets, right? So the way that we normally disclose it is just to have your total carrying amount for all your property, plant, and equipment on the face of your statement of financial position, right? Perhaps I don't want to waste too much time on this, but perhaps we can just discuss it a little bit further. You know, it all depends on you as an accountant again, and it all depends on how large the business is. We very often talk about minimum disclosure requirements. So, what is the minimum that needs to be disclosed? Right? And the minimum that needs to be disclosed is that you have for property, plant, and equipment one line item under non-current assets called property, plant, and equipment. Right? And nothing else except for the notes, which we'll talk about soon. But it all depends, ladies and gentlemen. If it's a small business and you can fit, and it's got very few, it's maybe only got two categories of property, plant, and equipment, then you can show it separately on the face of your statement of financial position. But we must also know what is the minimum requirement so that we can apply that. So normally that is what we would do, especially in the case of a large company, for instance. We will only have one line item called property, plant, and equipment under our non-current assets, and then we'll have a note to the financial statements where we then go and disaggregate, as they say. We would then go and show all our categories of property, plant, and equipment separately. So there we could do it in columnar form. Normally it would be done in columnar form. We'll do those tables today and next week and the week thereafter. It's very, very similar to some of the tables that you have in statistics as well. So in any case, when it comes to the notes, now we give further additional information when it comes to the property, plant, and equipment. And in that note, ladies and gentlemen, we are going to specify the categories such as property, plant and machinery, motor vehicles, whatever categories we have. We're going to then disaggregate them or show them separately. But we are also going to reconcile our opening balances, in other words, our opening cost and accumulated depreciation balances. We're going to reconcile to our closing balances. And those items in between opening balances and the closing balances will represent the movements within our property, plant, and equipment accounts. So, ladies and gentlemen, I just want us to again ask ourselves a few questions here, and then we can provide the answers. If we say we are going to reconcile the opening balances, and those the opening balance, the cost less the accumulated depreciation, basically represents your carrying amount at the beginning of the year, right? That's we've discussed now on a few occasions. If you are going to reconcile that with the closing balances, what would those items in between represent? I want us to, there are many possibilities, but we are going to be dealing with three possibilities in financial accounting 1, right? Later on, financial accounting 2 and 3 and 4, we are going to look at more possibilities. What would you say are the possible items that will affect or cause a movement in our carrying amounts from the beginning of the year to the end of the year? If you can just give me a few ideas in the chat there, please. Which kind of events, let's say events, what must happen for there to be a change from the beginning of the year to the end of the year? We've actually looked at 2 of those 3 possibilities already. Additions. Thank you, Nelita. Exactly. Additions, and there we go, Mr. Sitole. Disposals, right? Yeah, Angel, you are the star of the day. The Angel has got all 3 possibilities for us, right? So additions which adds to your cost accounts, disposals, which you subtract from your cost accounts as well as your accumulated depreciation accounts, and then the depreciation for the year, which adds to your accumulated depreciation. Thank you for all those answers, ladies and gentlemen. So in a nutshell, it'll be the additions or acquisitions that will affect the cost. It will be the disposals, which will affect the cost as well as the accumulated depreciation with regards to the item or items that we have disposed of, and the depreciation expense, which will affect the accumulated depreciation. Right. So that we must implement and incorporate into our note, our PPE or property, plant and equipment note. Right, ladies and gentlemen, and then we've got a typical note there, and that is what we are going to finish the notes with, if I can say that tongue-in-cheek. No pun intended, or maybe there was a pun intended. There we've got a typical table, which is our PPE note. It looks perhaps a little bit intimidating at the moment, but when we are going to do our class question 2, which will probably only be next week, we are going to see exactly how we draw up this note. So this is just an example. Maybe we can just discuss it briefly. There we can see we've got a column for each of our categories of property, plant, and equipment. This business has got 2 categories, the machinery and their vehicles, and our last column will always be a totals column. So 2 categories, and then they reconcile the opening carrying amount, which consists of the cost minus the accumulated depreciation. I've just added there the gross carrying amount. That is for future reference, because sometimes when we are using the revaluation method, that will not be the cost, that will be the revalued amount. But we'll only look at that next year. Okay. So for our purposes, it'll be the cost less the accumulated depreciation. Then we add the additions at cost. We take out all the disposals, and very important to note there, ladies and gentlemen, at its carrying amount. So we have to take out the cost of the item that we've disposed of, as well as the accumulated depreciation. We saw a little bit earlier that when we dispose of the item, when we de-recognize it, we credit the cost and we debit the accumulated depreciation. So both of them must be taken out, and then we add our depreciation expense for the year, which increases our accumulated depreciation, obviously. So we will work through in the note. We will build such a note. We will construct that note from scratch when we do some of our class questions. Let me just see. Nizia, is the same as note 3 tangible asset note? Yes, your tangible assets and your property, plant and equipment, they are exactly the same thing. It is just that nowadays we refer to it not as tangible assets, but as property, plant and equipment, because the title of the international standard is property, plant and equipment. Yeah. And I think Pabalelo and I think Leletu has answered you already there. Yes, and yes, seemingly so. Yes, that is the case. Right. Mr. Pokelo, interesting question. Does the buildings depreciate? Yes, it potentially can. It potentially can. You know, when it comes to property, in the old days, they used to group together land and buildings. That is not being done anymore, because potentially buildings have a limited useful lifetime, right? So buildings can depreciate. In fact, hotel buildings, for instance, the wear and tear allowance that you get from the revenue service is that you can claim wear and tear of 2% per year. In other words, you can write off the hotel building over 50 years. Why I'm just mentioning that, that is an indication that a building is not necessarily, unless it's the Parthenon or the Colosseum, a building is not necessarily forever, right? It is not necessarily forever. Exactly as Sibusiso says there, buildings can potentially be depreciated, but land you would normally not depreciate, because land normally, like Angel also says there, it normally appreciates. Okay, so buildings can potentially be depreciated. And like I say, in certain instances, the Revenue Service even allows you a wear and tear allowance on buildings, certain buildings. Yes, Ms. Makele, exactly. Immovable property, that is normally we refer to land itself, right? The buildings which is on top of the immovable property can actually depreciate, because that is not, it's not as permanent as we would like to believe it is. Okay. Anyway, so let's say it is potentially depreciable. Okay, buildings, most property, plant and equipment, except for land itself. Any other questions, ladies and gents? You are most welcome. Okay, then I'm going to stop sharing this. Yes, Lucille, and thank you for participating in last Saturday's session. I quite enjoyed it, and it looks like you did as well.
Yes, sir, I did. Sir, I have a one question regarding to the subject guide, regarding to the topics that we will cover in our November exam. What is AFS? AFS, like I'll type it out.
Sorry, I used the abbreviation there. AFS, AFS stands for Annual Financial Statements.
Okay, thank you.
Annual financial statements. Yes, I don't think we've ever mentioned it, but that is just generally when accountants talk about the year-end financial statements, they very often just say the AFS. Okay, so that's the annual financial statements. So yes, there's the final assessment, as you can see from the subject guide. It includes obviously property, plant, and equipment. It includes partnerships. You must still be able to do certain inventory calculations and VAT calculations. And then always, there might be a few questions around your annual financial statements. Is something a non-current asset, or is it perhaps a current liability? Where does it fit on the financial statements? So that is, you remember when we did basic financial statements. So all the information that we've accumulated during the course of the year will be somewhere in the final test, right? Okay, ladies and gents, I'm just going to stop sharing this document. I want to show you a different one. Some of the items I've actually copied from the notes, but there are a few additional notes that I've made that I just want us to have a look at. Let me just close this document on my side. So please just bear with me for a minute or so. Just want to find that other document. This document is not available on Blackboard yet, but I will make it available later today together with a recording. Yes, the exams is based on all the work we did during the year. If you have a look, if you have a look under under the menu items on the left hand side of Blackboard, if you look at those menu items, you will have to scroll down a little bit, but you'll see there's a menu item called previous year assessments. I don't think the November one from the old November ones are available yet, but it's a good thing that you are reminding me. I'll make them available during the course of the day. Right. They are very handy to have a look at. So I must just make a note of that on my side, that I make them available, but it will become available. They are already on Blackboard. You are most welcome. They're already there. It's just not visible yet. I must just go and make them visible. We didn't want to overload you with irrelevant pieces of information from the beginning of the year. So we only make those things available when they become due. But I must admit, I think I would have forgotten about that if you didn't remind me. Thank you very much, Zile. I appreciate that. Okay. Now let me just go and find that other document. Just waiting for it to appear on your side. It takes a few seconds. Okay. So this document initially just starts again with the definitions and the definition criteria. In other words, the definition of an asset and the definition of property, plant, and equipment. And then it also looks again at the recognition criteria, that come from the conceptual framework, as well as the additional recognition criteria for property, plant, and equipment that comes from IAS 16. Anyway, ladies and gentlemen, so this, I've just copied that there for you as a sort of almost like a reminder that it is important to be able to recite almost, to quote those definitions, but also to apply them in practice. We've already, so I've just written a few notes here, ladies and gentlemen. So we'll populate this document. As you can see, my autosave is on. So we are going to further populate this document as we discuss it. So there are just a few thoughts that I've typed down. So it's not the final document yet. We are going to work on it. We're going to put in all sorts of new thoughts in here. Let me just go to the could elaborate, because I heard a few noises there. Yes, okay. So you answered the questions there. Thank you. I didn't even notice that one. So when it comes to measurement, let's just recap again, ladies and gentlemen. This we've already discussed last week as well as today. When we talk about initial measurement, that is where initial cost and subsequent cost comes in. In other words, initial cost when we acquire the item, or subsequent cost when we replace a part of that asset. And then subsequent measurement, as opposed to initial measurement, that is where depreciation comes in, right? That is where we are starting to write down the book value or the carrying amount of the asset. Then just again a reminder, ladies and gentlemen, about how we determine the cost. The cost is determined by the purchase price firstly. So that is simply, as we've said earlier, what you are going to be paying for it, plus the directly attributable cost, which we again define here. By the way, I'll post a previous year recording where I actually sit and type these things under the additional resources if you are interested in watching that. But the discussion will be the same as what we are doing now. And then we also mentioned certain future costs. I just drew a line through that because we're not going to discuss the certain future cost in financial accounting 1. So those are the two factors that we have to add together to determine the cost of our property, plant, and equipment. We're going to be putting that into practice when we do our first class question, which will be next week. Directly attributable cost, there I just typed again that it is a cost that is necessarily incurred. So necessary is the key there, to bring the asset either to a condition or a location, not necessarily both, where it can be used as management intends. Right? What does management intend? All depends on the kind of asset. If it is inventory, the intention is to sell it. That then falls under IAS 2. If it is machinery, the intention is to manufacture a product. If it's perhaps delivery vehicles, it is to deliver the products to your customers. Then, as we've said already, ladies and gentlemen, when it comes to subsequent measurement, that is when depreciation comes into play. And here we've got the definition that comes from IAS 16. What is depreciation? And I think that's notes as well. So I'm just repeating it here. Depreciation is the systematic allocation. In other words, there's got to be a system that you use, that you apply to allocate the asset's depreciable amount over its useful life. And I've just added there the useful life that you expect to be using it as a business, the expected useful life. Then we mentioned last week, and there was actually a question in class about this last week as well. What are the methods of depreciation? It's in your notes as well, but today we are going to discuss it by practically giving it figures, and then we are going to do some calculations. Right. So, ladies and gents, if you haven't got a calculator with you, perhaps it's a good time to go and fetch one now, because I want you to do a few calculations for me. Many of the calculations will be very straightforward, so you can probably do it in your heads, but there might be a few that become a little bit too hard to do in one's head. So the methods of depreciation is the straight line method, ladies and gentlemen. That is almost like the workhorse of depreciations. That is one of those that is very generally applied to all categories of property, plant, and equipment. So we'll see today how the straight line method works. Then we've got the diminishing balance method, also very often used in many categories of assets, but I guess it's very appropriate to things like motor vehicles specifically. And then we've got the usage method, or sum of units method. Many years ago, it was even called the sum of digits method. That one is very limited to plant and machinery. It doesn't really work for any other asset that is not actually used in the manufacturing process. We'll see a little bit later when we discuss that, why that is the case. Right. So, ladies and gentlemen, I've just typed down a few thoughts here, so that we can, so that we do not forget about anything. So I just did that a few before class, not straight before class, some time ago. When it comes to depreciation, and I've mentioned this last week now, I just want to see who remembers. When it comes to depreciation, what do we have to calculate before we can calculate depreciation itself? Let's see who remembers that. Yes, thank you, Zila. Perfect. The depreciable amount, right? The depreciable amount, ladies and gentlemen. The carrying value, ladies and gents, that's the result of the depreciation, right? But before we can even get to the result, the carrying value, we must first calculate the depreciable amount, right? Now, ladies and gentlemen, the three methods have they differ in some fundamental aspects, and then some slightly less fundamental aspects, if I can put it that way. So let us maybe just look at the straight line method on its own first. When it comes to the straight line method, what is going to be your depreciable amount? Ladies and gents, that's why there's a question, straight line. What is the depreciable amount? We ask ourselves that question. In the case of that method, the straight line method, the depreciable amount is the cost less the residual value. And we said the other day, the residual value is the amount that you expect that you are able to sell it for at the end of the useful lifetime, right? What do you expect to get from selling or disposing of this asset when you stop using it? In other words, at the end of its useful lifetime for you, right? So our depreciable amount is the cost less the residual value. Then, ladies and gentlemen, when it comes to your diminishing balance method, that is not the case. That is one of those fundamental differences, right? There it is not the case. Let me just go back to Word so that I can perhaps highlight a few things. Perhaps just before we step away from the straight line method, the depreciable amount divided by the useful life in months or years will then give us the depreciation. Right, we'll come back to that when we do our practical questions. Then, ladies and gentlemen, in the case of the diminishing balance method, how do we determine the depreciable amount? In that case, we do not estimate the residual value up front. We do not. In the case of the straight line method, we estimate the residual value up front. In the case of the usage method or the sum of units method, we also estimate our eventual residual value up front, but not in the case of the diminishing balance method. Let me just go back to collaborate. Yes, thank you for those remarks there. In the case of your diminishing balance, you do not upfront estimate a residual value. In fact, ladies and gentlemen, your diminishing balance, every time you calculate depreciation, it gives you an estimate of its residual value at that point in time. That is the fundamental difference between the diminishing balance method and the other two methods, right? You do not estimate upfront the residual value, but the way that this method works, the way that this diminishing balance method actually operates or works or functions, is that it provides us with an ongoing estimate of its residual value. So when you calculate your depreciation by using the diminishing balance at the end of your first year of use, then the carrying amount at that point after the first year will be an estimate of its residual value. When you use this diminishing balance method at the end of your second year of use, then it will also provide you with an estimate of its residual value at that point in time. And the same as at the end of the third and fourth and so forth years, right? So we are going to put that into practice quite soon. We're going to do a few calculations here. When it comes to the usage or sum of units method, again, like we said, we are going to calculate the depreciable amount by taking the cost less the residual value, right? Cost less the residual value. And then we are going to use that usage method to depreciate that over the use lifetime. Okay, so now let's go and give this some figures, ladies and gentlemen. I want us to make this fairly simple figures so that we can easily calculate them for ourselves. So let's say, for instance, the cost. We're going to use this in all. Maybe I should type this on top. We're going to use this in all our examples now. So let's assume the cost equals, what shall we make it? Let's make it 1 million rands. Oh, no, my numlock wasn't on. Let's make it 1 million rands. Just to make our calculations easy, ladies and gentlemen, let's use nice round figures in your questions and in practice. They are not going to be such nice round figures. You'll have to adjust you'll have to use the actual figures, obviously, and they're going to be something like 9,999,225 rands or something, right? So they're not going to be such comfortable round figures. And then let's say our residual value. Oops. Let's say our residual value is 100,000, just to make it easy for ourselves. Right, so we've got the cost. 100,000 residual cost 1 million, I should say, cost 1 million rands, and our residual value is 100,000 rands, right? Yes, so you knew it definitely. Okay, right. Now let's go and calculate our depreciation for the year. So what do we have to calculate first, ladies and gentlemen? We first have to calculate the depreciable amount. So in this case, what would be our depreciable amount? It's going to be 1 million rands minus the residual value. Let me just go and look at all those answers there. So you're all saying 900,000, 900,000. Thank you. So I don't need to go and calculate it. Thank you very much. You are all spot on, obviously, as usual. So our depreciable amount is going to be 900,000 rands. Right. Let's also, now in this case, we have to go and also see what is our useful life, right? What is our useful life? And we've got to express this in months or years. So let's, for instance, say, oops, no, that's not where I want to type this. I want to type it in the next field. So let's, for instance, say 5 years, right? 5 years is our useful lifetime. Our useful lifetime is 5 years, right? Now let's make a few other assumptions, ladies and gentlemen. Let's make a few other assumptions. Let us say, maybe I should put this on top. Financial year end. Financial year end, let's make that end of December, 31st of December 2022. Okay, so we've got a few facts and figures now. So we've already calculated our depreciable amount, ladies and gentlemen. Now we've got to go and calculate the depreciation. Let's say the useful lifetime is going to be 5 years, right? And that we've purchased, or let me rather say acquired, let's say this is a machine. Right, so those are our facts now. Let me just go to the chat quickly. Yes, Letu, is there a case where we have to calculate the residual value? That's what we are doing. Oh, the residual value. Let me think about that. Not in financial accounting 1 or financial accounting 2. I think, if I remember correctly, that is covered in financial accounting 3. So you will always be given the residual value, right? For academic purposes in financial accounting 1, you will be given the residual value in all cases, right? You will always be given the residual value. When it comes to the cost, you might have to calculate the cost yourself, right? So the cost you'll have to calculate using all the information that we've spoken about. It includes your purchase price. It includes directly attributable cost, which qualify, which not. But your residual value will be given. Okay, Letu, happy? Okay, you are most welcome. No. No. Residual value will be residual value will be the cost less your depreciable amount, right? So your residual value will be the cost less the depreciable amount. But normally you'll have to calculate the cost. They will give you the residual value. So that means you can then go and calculate the depreciable amount. And then thereafter we calculate the depreciation. Okay, anyway, so we've got a few facts and figures here. Now, ladies and gentlemen, how are we going to calculate the depreciation? Let's type it there. Let me rather say for the year ended 31 December. Who wants to give us a few thoughts there, or formulas there? If you can give us a few thoughts in the the percentage, Lucille, comes in later on when we are going to be discussing. You can put a percentage. I'll talk about that now. You can put a percentage there as well, but when it comes to the diminishing balance method, there you have to put a percentage, right? Under the straight line method, it is optional. But under the diminishing balance method, you have to have a percentage. There's no other option, right? So we'll see that very soon. As a matter of interest, ladies and gentlemen, let's add a percentage like Lucille suggested there. Like I said, this is not necessary in the case of the straight line method. So if you are going to have if you have calculated a useful lifetime of 5 years, what is the percentage that you are going to write off as depreciation annually? If you can type for me in the chat, please. If you're going to use it, if your estimated useful lifetime is 5 years, what percentage are you going to depreciate it by every year? Correct, Kuchle? Right? 100 divided by 5 gives you what? 100 divided, thank you, Enrique. 100 divided by 5, by 5 gives you 20. Right? 100 obviously represents the full lifetime, 100%, right? If you are going to write it off over 5 years, you divide 100 by 5, that gives you 20% per year. So maybe I can just add that in brackets there, just for those who want to see it. 20% per annum. Right, ladies and gentlemen, now we've got to go and calculate the depreciation. Where do we start? We start with well, we obviously started by calculating the depreciable amount. Now we've got to take that depreciable amount, which you have already said is 900,000, right? By 900,000. So 900,000 is the amount that we want to write off over the useful lifetime. So that is why it is called the depreciable amount, right? So yes, all of that, the 20% is correct. There we've got some formulas. Thank you so much, ladies and gentlemen. Okay, let's go and apply some of them. Now, there are many ways in which you can do this. Maybe we can do more than one way in which we can do this, but let us just start with the basics, right? So first of all, we have to now go and see how many months is represented in that full 5-year period, right? Or we can just take the 5-year period. It doesn't matter. Like I say, there are so many ways in which we can do that. Let's see if we can type all of them here. I know we are slowly running out of time, but let's at least do this one method completely today, and then we can look at the other 2 methods next week. So, ladies and gentlemen, so first of all, we've got to say 900,000 rands is our depreciable amount. That, in other words, is the amount that we want to write off to 100,000 rands at the end of the useful lifetime, right? The cost was 1 million rands. At the end of the useful lifetime, we want it to have a carrying value of 100,000. Does that make sense? The cost was a million rands. At the end of the useful lifetime, we want a carrying amount of 100,000, which means how much do we have to depreciate over the 5 years? 900,000. You get the idea, right? You get the idea. So now we've got to go and divide that by 5 years, right? 5 years to give us the annual depreciation. 5 years to give us the annual depreciation, right? Let us just maybe get a subtotal there. If somebody can work that out for me, 5 times 9 is 45. So that will probably be 45. No, where am I going with this? 900,000 divided by 5 is 180,000. Let me just see if, if you also get that. 180,000. Thank you all for those answers. You are much quicker on the calculators than I am, obviously. So let us just say that is then 180,000. What does that represent? Our annual depreciation. In other words, if we had owned this, or if this had been available for use, I should rather use the correct term, if this item had been available for use for the full financial year, then the depreciation for that year would have been 180,000. But for how many months was this item available for use in actual fact during this financial year? For 6 months, right? We said it was only acquired on the 1st of July. So if we take it July, August, September, October, November, December, and you don't be shy to count on your fingers. Even at my age, I still sometimes do it. So no problem. So I also get 6 months. So it was only available for use for 6 months. So we cannot depreciate it for a full financial year. We can only depreciate it for half of the financial year. So you can either now say multiplied by a half, or you can say multiply by 6 and divide by 12. Right. That should then give us 90,000, because that's half of 180,000. Also, thank you for confirming that. So you all get 90,000. Right. So our let us maybe just recap now, ladies and gentlemen. So our cost was 1 million rands. We said at the end of the useful lifetime, we want to write it off to 100,000 because we believe we can sell it for 100,000. That will be its value at that stage. So the amount that we actually want to write off over the 5-year period would be 900,000, right? And then we said this item was purchased halfway through the year. We believe we can use it for 5 years. So 5 years is our expected useful lifetime. So we are going to take the depreciable amount divided by the number of years that we are going to be using it, and then we multiply it by the number of months that we are going to be using it during the course of this year, or that we have used it during the course of this year, divided by 12. Okay, there's a few alternatives, ladies and gentlemen, so we're not going to have time to do the other two methods, so I might as well now go and show you some other methods here that works out exactly the same. Or alternatively, you could have said, you could have converted that to months first and not years. You could also have said 900,000. How many months are there in 5 years, ladies and gentlemen? How many months are there in 60? 60, thank you. So there are 60 months in that full 5-year period. So we could have said divide by 60. If I can just find the divide, but there we go, divide by 60. So now we've converted the 5 years into months first. Oops. Sorry, ladies and gentlemen, I've now gone and lost my Word document. Let me just maximize it again. There we go. Divide by 60 and then multiply by the number of months we've used it during this year, which is 6. Does that also give you 90,000? If you can just maybe confirm for us. Got my Word document back. Yes, it does. So that also gives us 90,000. So you see, there are many ways that you can do this. You can divide it by the full number of years and then apportion the annual depreciation, or you can convert the number of years to months first, and then you can just divide it by the number of months and multiply by the number of months that you've used it, and divide by the number of months in that full useful lifetime period. And then let's just maybe finish off. I'm sorry, I know that you have to leave for another class. Just one other possibility, ladies and gentlemen, how you also could have done this if we use Lucille's method. We could have said the following: 900,000 multiplied by 20%. That is another possibility. No, that's not percentage. Where's percentage? Multiplied by 20%. That should, you can just confirm for me, that should also give you 180,000, and then you multiply it by 6 and you divide it by 12 again, and that should also give you 90,000. So that should all give you 90,000. My autosave is on, so I have saved the document. Okay, it does. Thank you for confirming that, ladies and gents. I think I'm not going to post this document today yet because it's not done yet. I'm obviously going to post the recording of the class, but then I'd rather post this document next week. If it's okay with you, next week after we've finished all the methods there, then I'll post the complete document. Otherwise, if you want, I can post it now and repost the final one later on. But you choose. I'll post it next week after we finalized it. That okay? Thank you, ladies and gentlemen. Sorry, I've gone a little bit over my time, but thank you so much. When done, yes, thank you, Lucille. That I also think that will make more sense. Otherwise, you might just become confused and use the wrong version. So let's just use the final version. Thank you very, very much, ladies and gentlemen, for attending. Enjoy the rest of your day. I'll see you again next week, Thursday. Then we'll continue with these methods, and we'll also start with our various class exercises. There are quite a number that I'd like us to do. Thank you. Bye-bye.